Welcome back to the Deep Dive. Today we're doing something a bit different. We're pulling back the curtain on a massive global business.
That's right. We're looking at the cruise industry, specifically through the lens of, well, some pretty dense corporate filings from Q3 2025 for a major player.
Exactly. The consolidated statements of income, capacity reports, those lengthy litigation disclosures. It's a lot.
It really is. Thousands of pages, often full of jargon. So our mission today really is to cut through that, find the core truths, understand their strategy.
And look at the risks, the debt structures, all those commitments they've made. Find the surprising nuggets, connect the dots.
Precisely. We want to figure out what's really going on behind the numbers.
Okay, so where should we start? Maybe the top line. Revenue always tells a story.
Good place as any. Looking at the consolidated statements of income for the 3 months ending August 31st, 2025, the recovery narrative looks exceptionally strong.
How strong are we talking?
Well, they pulled in $8.153 billion in total revenues just for that quarter.
Wow. Okay, and how does that compare to, say, last year?
That's a very solid jump from $7.896 billion in Q3 2024.
And the year-to-date picture, is it holding up?
Even better, actually. 9 months into 2025, they're over $20.292 billion.
Okay.
Which is, well ahead of the $19.083 billion they had at this point last year.
So the cruise business is definitely back. Demand seems robust.
So absolutely. But it's interesting to break down where that money's coming from, right? It's not just ticket sales.
Right. The passenger wallet, as they sometimes call it.
Okay.
What's the split?
Okay, so passenger tickets are still the main chunk, obviously. $5.43 billion this quarter, $13.3 billion year to date. That's the core.
But the other part, onboard spending.
That's where it gets really interesting. Onboard and other revenue that hit $2.723 billion in the quarter alone.
$2.7 billion in 3 months.
Yeah. And almost $7 billion year to date. It's substantial.
Nearly $7 billion. What does that tell us about the people cruising now post-pandemic?
Well, it tells you they're not just buying the basic trip, are they? They're really opening their wallets once they get on that ship.
So the specialty dining, the excursions, Wi-Fi, all that stuff.
Exactly. It speaks volumes about how well they've dialed in their pricing for all those extras. It shows they've really mastered turning that initial ticket sale into, well, significantly more profit per person.
And that flows down, I assume, to the bottom line, net income.
It certainly does. And that net income surge, honestly, it's probably the most impressive number in the whole filing.
How impressive.
For the first 9 months of 2025, net income reached $2.338 billion.
$2.3 billion.
Yep. Which is a huge increase from the $1.613 billion they made in the same period in 2024.
Okay, that's more than just recovery. That's serious profitability kicking back in.
Massive recovery in profit, not just bookings. But to really get how they did that, we need to flip the coin. Look at costs and debt.
Right, the operational side. Because I saw something there that kind of jumped out at me. Fuel costs.
Ah, yes. What about them?
You'd expect them to be a headache, right? Volatility maybe increases, but they actually decreased in Q3.
They did. Dropped from $515 million in Q3 24 down to $451 million in Q3 25.
And year-to-date, that's hundreds of millions saved. How?
It's likely a mix of things. Good hedging, maybe better voyage planning, but also, crucially, newer ships.
More fuel-efficient vessels coming online.
Exactly. Replacing older gas. It was huge, a structural shift. For the 9 months, net interest expense dropped by $317 million.
$300 million, just on interest.
Yeah, down from $1.4 billion last year to just over $1 billion this year.
Yeah.
That's a 23% reduction in financing costs. Massive.
Okay, how does that happen? The notes mentioned lower total debt, lower average rates,
Yeah.
and something called increased capitalized interest.
Right. So lower debt and rates, that's straightforward refinancing, paying things down. The capitalized interest, think of it like this.
Yeah.
When they're building a huge new ship, right, costs billions, they're paying interest on the loans for that construction before the ship earns a penny.
Right.
Instead of expensing that interest payment now, impacting current profit, they essentially add that interest cost to the total cost of the ship on their balance sheet.
Ah, so they're deferring the recognition of that expense, rolling it into the asset's value.
Precisely. It makes the current income statement look better, lowers the reported interest expense today while the ship's being built.
Clever accounting, but standard practice for big construction projects, I suppose. It provides immediate relief.
It does. Now, getting those lower debt levels and better rates wasn't free. There was a trade-off.
What was that?
Debt extinguishment and modification costs,
Right.
basically fees for refinancing, those shot up.
How much?
$366 million dollars for the 9 months this year compared to just $78 million last year.
Wow, so they paid over $350 million in fees.
To restructure loans, get better rates, clean things up, it's a big upfront cost.
But an investment, really. Paying now to save much more on interest down the line.
Exactly. Painful short-term, but strategically vital for long-term financial health.
Okay, let's pivot from finance to the physical side. The ships themselves, there seemed to be a bit of a paradox in the capacity numbers.
Yeah, the fleet report, you saw that too. A short-term dip, but long-term growth.
Right. Capacity measured in available lower berth days, or ALBDs. It was down 2.5% for Q3.
Correct. A temporary dip. But if you look at the 9 months year to date, overall capacity was still up by 0.9%.
So what caused that dip in the summer quarter?
Strategic pruning, essentially. They got rid of some older, maybe smaller, less profitable ships.
Like which ones, did they say?
Yeah, they mentioned a 460-passenger seaborne ship and a 2,000-passenger P&O Australia ship leaving the fleet. It seems like a move towards quality over just quantity.
Okay, getting rid of smaller units.
Right.
And the growth then, the year-to-date increase.
That's all about the big new arrivals, huge brand new ships entering service.
Which ones?
A massive 5,360-passenger ship for Carnival Cruise Line, a 4,310-passenger one for Princess, a 2,960 for Cunard.
Big ships.
Very big. Plus, they did an internal shuffle, moved a large 4,240-passenger Costa ship over to Carnival Cruise Line.
So the strategy is clear. Shed the smaller, older stuff. Bring in the massive new, probably more efficient and profitable ships.
That seems to be exactly it. Maximize efficiency and onboard revenue potential.
Okay, strategy and operations look positive, but there's always the legal side. High-stakes navigation there too, right? The litigation disclosures.
Always. And the big one is still that Cuban situation, the Helms-Burton Act case.
Right, the trafficking allegations related to using a specific port in Cuba. They initially lost that one, didn't they?
They did. Big setback. A $114 million judgment against them back in December 2022. A major headache.
So what's the update in this filing? Has anything changed?
Something crucial changed. The Court of Appeals actually reversed that $114 million judgment.
Reversed it completely. When did that happen?
October 22, 2024. So a huge win for them legally.
But is it completely over?
Not quite. The other side, Havana Docks, filed what's called a certiorari petition with the Supreme Court back in March 2025.
So they're asking the Supreme Court to take the case. That sounds risky again?
It is. Asking SCOTUS to hear your case is always a long shot, but the risk is there. However, the company states pretty clearly in the filing that they don't believe the ultimate outcome will materially impact their financials.
Is that just lawyers being optimistic, or is there a real reason they feel confident, even with the Supreme Court potentially looming?
That's the key question, isn't it? It's probably two things. First, having the appeals court reverse the decision gives them very strong legal footing.
Okay.
Second, even if SCOTUS did take the case, the appeals process might have narrowed the scope or potential damages under Helms-Burton. So maybe they feel the potential financial hit is now capped or manageable.
So they've effectively moved a known massive liability off the immediate books and replaced it with a sort of managed, ongoing legal risk.
That's likely how they see it. It dramatically changes the risk profile on the balance sheet.
What about the other legal stuff? Those class actions from passengers after COVID?
Those seem to be getting contained quite well, actually, which is another big win.
How so?
Well, in Australia, a court found them liable for negligence for the lead plaintiff.
Okay, so they lost on liability.
Yes, but the damages awarded were tiny. Basically just medical costs.
Why so low?
The court explicitly said that damages for things like distress and disappointment were already covered by the refunds the passengers got.
That sets a really important precedent, doesn't it?
Hugely important. It means even if they're found liable, they already issued refunds, the extra financial exposure per person might be very limited.
Any other updates on those?
Yeah, a similar case in Italy saw most of the plaintiffs' claims rejected entirely in March 2025. So overall, they seem to be successfully managing down those pandemic-related liabilities.
That's definitely good news for their financial health. Okay, now, let's get into the really dense stuff. The fine print. The loan covenants.
Right. The rules set by the lenders. Critical stuff. Control and financial guardrails.
Let's start with control. The filings talk about permitted holders. What's that about?
It's essentially defining the founding family, the heiresses, their spouses, descendants, trusts, etc. The documentation spells this out very clearly.
And why do the banks care who specifically controls the company?
Think of it as lender insurance. They're lending billions based on the management and strategy of the known entity, the founding family group. They want stability.
So there's a specific threshold?
Yep. The covenant states this permitted holder group must collectively own more than 50% of the capital stock held by that group. It locks in the current control structure.
Got it. Ensures continuity. Now, the financial guardrails, the performance targets they have to hit.
Right, the covenants that really act as financial health checks. These mostly kicked in around August 2025. Two key ratios.
Okay, what's the first one?
The total leverage ratio. It basically measures their total debt borrowed monies against their total capital base or consolidated capital.
And the limit.
It cannot exceed 0.65.
So debt can't be more than 65% of their total capital, a cap on borrowing.
Exactly. Prevents them from getting over-leveraged again. The second one is maybe even more important right now, the interest coverage ratio.
Okay, what does that measure?
It measures their ability to actually pay the interest on their debt using the money the business generates. Specifically, it compares EBITDA to consolidated net interest charges.
Right. EBITDA. Let's quickly define that for listeners again.
Sure. Earnings before interest, taxes, depreciation, and amortization. It's a common way to look at core operational cash flow, stripping out financing and accounting effects.
Okay. Operational earnings versus interest payments. What's the required ratio?
It started at a minimum of 2.50 for the tests in August and November 2025.
Meaning their operational earnings had to be at least 2.5 times their interest payments.
Correct. It shows the lenders they have a healthy cushion to make those payments. It's a key measure of comfort for creditors.
Okay, so wrapping this all up, it feels like an overwhelmingly positive story from these Q3 filings.
It really does. Revenue way up, net income soaring thanks to strong demand, but also that smart debt management cutting interest costs.
Fleet modernization happening. Major legal risks seem to be receding or being managed.
It's a pretty clear picture of a company moving firmly from crisis recovery into strategic, profitable growth mode. Textbook, almost.
But there's always a but in the fine print, isn't there? You mentioned the immediate future pressure from those debt covenants.
Exactly. That interest coverage ratio we just talked about.
The 2.50 minimum.
Right. While they're hitting that comfortably now, the rules are set to change. The covenant has a built-in step-up.
Oh. When does that happen and what does it change to?
Starting February 28, 2026. So very soon, that required minimum ratio jumps from 2.50 up to 3.00.
Wow. Okay, that's not insignificant. From 2.5 times interest coverage to 3 times.
It's a substantial leap, a financial sprint, as you put it earlier. They have to demonstrate just a few months from now that their core operational earnings can cover their interest payments 3 times over.
So the pressure stays on, even with the good results now.
Absolutely. This hard step-up shows the expectations baked into those loan agreements by the creditors. They want to see sustained and indeed improving efficiency and profitability.
So that's really the final thought for you, the listener, isn't it? The current filings paint a rosy picture, yes, but the real test is encoded in that covenant jump. How successfully can this giant navigate that pre-programmed increase in financial obligation? That structural test is going to define their 2026.